Hey everyone, this is Hunter Satterfield, one of the partners here at Kane Waters and Associates, as well as the Chief Investment Officer. As always, I am joined by my two esteemed guests, Brian Bortz, who is my fellow partner here at Kane Waters, as well as the head of our investment committee, and then Brad Sanders, who's the managing director of Tectonic Advisors. This is your September market update. For the month of September, the S&P 500 was down 4.8%. Global stocks were down 4.2%. Domestic bonds down 2.5%, and global bonds were also off 2.9%. So a pretty gnarly month, and we're going to get into exactly why that was the case. One thing that's super interesting as well is the S&P is still up for the year, right at 13% through the end of September. Interestingly enough, though, the equal weighted index, which we talk about, periodically, whether it's on our podcast or on Brad's monthly or weekly meetings, the equal weighted index is only up 2%. So there's a big gap between the 13% that the S&P's up and equal weighted only being up 2. And that's largely driven by those what we're calling now the Magnificent Seven. So we'll definitely get into that and what's creating that. But first, I want to go over to you, Brad. So we had a Fed meeting here in September. They paused on these rate hikes that seemingly have been going on for quite some time now. So ordinarily, maybe that doesn't create havoc in the markets, but then of course there was all of this language that was very hawkish and being that rates were going to be higher for longer. And so now we're seeing some of those impacts flush through the market. So you want to talk a little bit about what the FOMC said and why that's impacted the markets, as well as what we're looking at for the next 12 to 18 months as a result.
Yeah, I mean, this is kind of right in line with our main thrust for the year, which is that they were going to keep rates higher for longer. And I think the reason the bond market acts so poorly is because if you'll remember, in March, I believe it was March, when Silicon Valley Bank went under, the market priced in a 2008 scenario and priced in multiple rate cuts going on this year. And when the Fed issued that language this month, it became very, very clear and apparent to bond market participants that they weren't going to get those rate cuts and they weren't going to get them anytime soon. So you've had this unwind of these kind of faulty rate cuts that were priced in because of a panic, a very brief panic. Um, I think what you have going forward is a Fed that's very cognizant of their mistake in the mid 70s. If you mirror up inflation that started now versus what started in the late 60s, it's the same chart. It's got the same trajectory down now, and it's going the same way. And what happened in the 70s was the Fed thought they had inflation tamed, it hit their target, and they eased in like the late 76 timeframe. And then we got that secondary wave of inflation that went up into the double digits. That's the one everybody remembers. The Fed had inflation on the right track, and if they eased too early, Fed doesn't really control inflation. So when they eased too early, everything spiked, and then you had Paul Volcker come and do the mess. So it's very, very clear if they're going to make a policy error, meaning they break something in the economy, it's going to be on the side of keeping rates too high for too long or even raising them too much. It wouldn't shock me to see one more quarter point hike this fall. I don't think we'll get it. I think they're done. But I think if we do get one, we'll get one more maybe in the December timeframe, and then they'll be done. So what that means is that the market is now having to digest the fact that zero interest rate policy is likely over. The Fed target is 2% for inflation, which is higher than it was the last decade. Most smart invest people that are way smarter than me that I listen to think that the best they're going to be able to do is get it into the low threes. So when you have that, you can't have zero interest rate policy because you'll run severely negative real rates, which is extremely damaging to growth into the economy on the long term. So we just all need to kind of reset the bar on rates. And frankly, for our investors, having real interest rates is a very good thing for the long term. Markets behave more rationally. It's easier to make money. Your bonds actually pay you. That's a novel concept. You actually get yield that we haven't had for the last decade. So this is a good thing. We're going to have to go through this adjustment period as the market re-rates all the ZERP, fluff that we have in the market. It's the big reason why the Magnificent Seven stocks are so big, is because they're still kind of riding that tailwind from all this zero interest rate policy, which tech stocks really like. and they're riding right into a headwind, which is the things that tech stocks do not like, which is higher and more persistent inflation, higher interest rates that punish asset-light companies with high cash flows. And so the market, those are just going to have to re-rate lower, which will kind of drag the indexes down. We'll close the gap between what you mentioned, the S&P 500 and the S&P equal weight. The good news is the majority of the market's already kind of priced in a recession. Well, they did it last year. A lot of the market, as you mentioned, is only up 2%. We haven't like rebounded, and now we got to flush all that out again. A lot of the market you can just go ahead and buy and just stay away from the really expensive stuff that hasn't re-rated yet. And I think you're going to be okay, and we can kind of ride through this.
Yeah, that's really great stuff, and it's echoing a lot of what we're seeing when we talk, not just in the public markets and just not just in the public stock and public bond, but what we're seeing also in the private markets as well. All that stuff's being re-rated, and so I loved your point there though about there's still really good stuff to buy, and we continue to focus on that here for our clients of where is there stuff to buy and to continue to invest very broadly. So Brian, just come over to you a little bit to talk about that lack of breadth in the market that we talked about there at the very beginning, that gap between the S&P and the equal weight. What does that mean, I think, for our clients as they're thinking about how to invest kind of here in the next 12 to 18 months?
Yeah, thanks, Hunter. I've really tried to focus our clients on understanding what's going on in the market right now. Brad made some excellent points, and we've talked historically about kind of those top 7 stocks, but really looking at that and understanding that there are really good valuations that are out there of good companies. I think there's going to be a disparity in what the quote unquote S&P 500 does when you start looking at indexes, because those top 7 stocks are going to reprice at some point. When you look at the top 3 themselves, Apple, Microsoft, and Amazon in that order, and the size of those stocks are just astronomical, almost unfathomable, because you think about Amazon being a $1.3 trillion company. And not too long ago, we'd never had a $1 trillion company. And then you try to figure, well, how much smaller is Amazon than Microsoft, which is number 2 on the list? You would have to add a Berkshire Hathaway, an ExxonMobil, and a Disney to Amazon, and it's still not as big as Microsoft from a market cap perspective. And then you look at valuations, and Apple and Microsoft are trading, well above 30 times earnings, which is about historically twice what the average S&P stock trades at. And then you go down to Amazon and it's trading at 102 times earnings. And not that these are bad companies, it's just that they're really, really, really out of whack from a historical valuation standpoint. So what I'm trying to tell our clients are there are other stocks that are out there, and your portfolio is going to move differently than the S&P over time. And that's probably going to be a good thing as we move forward with all the volatility. So really understand the breadth and depth of the market. There isn't a lot of depth right now, and understand that what we have is very, very different than the index.
Yeah, that's great info. And folks, we're going to enter into now what is always an interesting month in October in the markets. And so we've got a lot more, as Brad already mentioned, some stuff that we will have from the Fed later this fall. So please stay tuned for that. We will be back in front of you at the end of October. Thank you so much.